Hi guys, welcome to one more video from Optionables. I'm Sujit, and in today's video we'll be learning about a simple strategy but effective one. It will be based on Banknifty, and the capital requirement for this strategy will be somewhere around 1 to 1.25 lakhs. So in this strategy we'll be analyzing the data of Banknifty movement for past 10 years. We have collected the data and we'll be analyzing it. Once we have analyzed, we'll be backtesting and building a system. First we'll be building a system for the suitable data, whatever we have got. Then we'll be backtesting it to analyze how the strategy would have worked. Once we do this, we'll be able to build a model and we'll be able to understand the risk reward involved in the trade and historically what would have happened from past 4 years, because buying Nifty options started in 2017. So from weekly options basically. So from then onwards, what would be the result and what would be the outcome. So once we analyze that, we'll be modifying the system to get better results. So all this will be learning in this module or in this video. And before moving forward, please hit the subscribe button and share it with your friends. So in today's video, we'll be majorly learning about building systems which will work in all market conditions, irrespective of markets, whether moving up or down. And in this, where we'll be learning that in this system, there won't be any discretionary trade. That is, my personal bias or your personal bias won't be in picture. And we'll have complete backtested data of the systems, whatever we are building in. So that is the three things what we'll be learning in this video. And going forward, the major question all people have is why we lose money in stock market. So one interesting fact is that we don't understand the data, and we rely mostly on our emotions. So once we do that, we'll be forced to book some loss if the trades are not going well. And some of the factors are greedy as well as fear. So these two conditions or these two factors of our emotions will make us take hasty decisions, which will affect our trading in the longer run. So that's the reason we try to overcome this basically by building a system, basically system based trading or rule based trading. So there will be predefined entry, predefined exit, and once we have that, we'll not have our emotions playing that much in the game. So that's the whole idea of building a system. If you can control your emotions and do that, then that's fine. Discretionary trading also works because we do both discretionary as well as trading. You would have seen all our videos which contains both discretionary as well as system. So not all time system trading works, not all time discretionary trading works, but you need to know what works better for you. So that's how you trade for yourself and trade with the system. And mostly why most of the people lose money in stock market is because 95% of people what trade doesn't have consistency in the strategy whatever they do. So today they'll be trading straddles. 3 days it will make money. Fourth day they'll lose. Fourth day, that is the time when they'll tell this strategy doesn't work and they'll just quit the strategy. So what happens is there is no consistency in whatever they are doing. So that's the reason majority of our crowd or majority of our public lose money in stock market. Next most important part is most of us, when we enter our trading career, we don't have any data regarding the probability or numbers whatever we are doing. We just go with respect to some of the other calls which other people give, and we just rely on that. We don't do our own analysis or our own study before entering the market. So that's the one of the cause why we lose money in stock market. And probability and risk, we need to have good idea about these two terms, because once we have good risk understanding of the risk, we'll be able to design any strategy. 90% of our problems relies in position sizing. So when we take position sizing or when we take any position which is over our limit, that is when, if some or the other event occurs, that is when we lose most of the money. And mostly all of us would have gone through all the scenarios in our trading career. So how to overcome this is based, we have to have proper position sizing, as well as we need to understand good risk to reward strategies. So these are the two things which will keep us in the game, because how much ever good strategies anyone gives, it's up to us to take it or not, because everything relies on the position sizing. Because what happens is 3 days you go with one position, fourth day you double your positions, that's when you take a hit and you are out of the market. So whole idea is to stay in the market as long as possible. Once we do that, we'll be able to build confidence and we'll be able to build better and better trading systems, as well as we'll be able to take better trading decisions. So I have taken data from March 2006 to March 2021, and there are almost around 3,000. There are almost around 3,683 trading days, and in that we see that markets trend more than 2%. It is only around 365 days. More than 2% of the market movement. There is only 365 days which has taken place, and market tends to be in the range bound of 0.8 to 2%, more than 1,000 days, and market tends to be between plus or minus 0.8 more than 2,000 days. So that is what we have seen from the data. So these are the data which is available on NSE website. You can go ahead and check it out. You can take it, you can filter it and sort it out. So based on the data, we realize that market tends to remain in a range of plus or minus 1%, more than 62% of the times. That is from open to close of a day, basically, not high to low. We have taken open to low, open to high. Sorry, we have taken open to close, not high to low. So based on that data, we analyze that markets remains to be in a range of plus or minus 1% for more than 63% of time. Slightly trend setting, that is 0.8 to 2%, will be somewhere around 27%. More than that, there are days, but it is only around 9 to 10%. So now, before moving forward, I would like to show you one more interesting data, wherein once we have analyzed the data of market for past 10 years, so we'll see which are those days wherein markets tends to be in range. So we can design a strategy for that. So for that, I have taken data from basically NSE. So I have filtered out data such that I'm taking days for only Wednesday and Thursday. Why Wednesday and Thursday? It is very simple. Why Wednesday and Thursday? It is very simple. Last day of expiry, that is Wednesday, will have highest overnight theta decay. So in this strategy, we'll be learning more about BTST or STBT, basically sell today, buy tomorrow. So that type of positions what we take in this strategy. So I have taken data also, and I have filtered out only Wednesdays and Thursdays, so that I get to know what is the exact change from Wednesday's closing to Thursday's open. What is the exact percentage change of Nifty and Bank Nifty? Basically, I'm considering Bank Nifty. So what is the exact percentage change of Bank Nifty from Wednesday's closing to Thursday's opening? So I have taken that. And I have filtered out the data. So this is the filtered out positions. And what I have done is I have also made it into this. So from 2000, I have data from 2005, but I have filtered out and I have taken from 2010 so that my data is more relevant. I have much more refined data. So once I do it, I have also plotted a histogram for analysis of the data on Wednesday's closing to Thursday's opening. So from this, I get to know that market tends to be in the range of minus 0.368 to plus 0.632 or 93% of times. So this is the data what I have taken. I have filtered it out. Basically what I did was I took all the data from 2010, each and every days, open, high, low, close. Then what I did, I sorted out only Wednesday and Thursday. So Wednesday and Thursday for all these years from 2010. Then what I did was I Wednesday's close and Thursday's open, I took the percentage change. So based on this, and I filtered out only Wednesday's data so that I get to analyze percentage change between these 2 days. So what we realized was market tends to be in the range of more than 0.1 to 0.8, that or minus 0.368 to plus 0.632, the most number of times. And markets tend to be in somewhere around minus 1.3 to 1.3% to plus 1.6%, almost these many number of days. So according to the statistics, we realize that 93% of times only on Thursday and Wednesday and Thursday. So Wednesday's closing to Thursday's open, market tends to be in the range of plus or minus 1%. So for this, we can design a strategy because we have to just trade one day for extra income, basically, because you will have overnight funds which are doing nothing. So you can deploy all these funds, some part of the funds for this trade too, so that you can increase your return by little, another 20% or 25%, not more than that, because since you are taking only one day, you can't expect more returns in this. You can expect only for one day, you can expect somewhere around 20 to 25%, and overall in a year, somewhere around in 52 days. So in a year, 52 days, so you have to trade, that's all. And in that, you'll be somewhere getting around 20 to 25%. This is a historical data what we have got. So you can expect similar things, but we don't know how it will work out. But these are the lines which it has been worked out, and we can expect similar things in the upcoming days also. So to brief, what I did, I took the data of Bank Nifty past 10 years, that is from 2010 June onwards, and I filtered out Wednesdays and Thursdays. Why I did? Because that is the most of the times it will be the expiry day, and there might be error of around plus or minus 10%, because sometimes what happens is expiry comes on Wednesday because Thursday will be holiday. So there might be a little bit error there, plus or minus, but we can rely on it. And second one is, after I filtered out the data, I analyzed what is the percentage change between open of Thursday and close of Wednesday. So once I analyzed this data, I got to know that market tends to be in the range of plus or minus 1.5%. So for this range, I'll be designing a strategy now. So what are the prerequisites for this strategy? It is simple. We recommend the capital somewhere around 1 to 1.25 lakh. And why? Because I'll be informing you later. 1 to 1.25 lakh. And this strategy you enter exactly at 3:15 p.m. on Thursday, and or the day before expiry, and exit on 9:20 a.m. on the day of expiry. So if the expiry is on Wednesday, you enter it on Tuesday also, and exit on the expiry day. So basically you enter it on 3:15 on day before expiry, and exit on the day of expiry by 9:20 a.m. So in this, we use only weekly contracts, weekly expiry. The contracts which are expiring that week, we'll use only that thing. And why are we using this? Because last 2 days, that is Wednesday and Thursday, there will be high theta decay, and overnight decay will also be there. So we'll be building that. So any strategy what we design, we need to have high probability of success or high probability of winning. So what we do is majorly we come up with a risk defined strategy which has high probability. So we have seen that markets can be range bound, or it can go up or go down. So these are the three scenarios which are there, and due to theta, the selling options can get you extra bucks, and it will be probability of success will be somewhere around 67%, because 2 out of 3 scenarios you will be making money because of the factor of time decay. I think most of you would have understood this. If not, please check out our video on short straddle. There we have explained in detail of how exactly time decay and all those things work on short straddle. If you have not seen our video on option Greeks, you can go ahead and watch it. So you'll be able to analyze the option Greeks also. With option selling, you'll have at least a probability of winning of somewhere around 66%. So this we all know. So based on this concept, basic concept, we'll be creating a strategy. So what strategy are we using? We are using a strategy called as short strangle on Bank Nifty. Since most of you were asking about the strategy on Bank Nifty, how we can do or not. So we thought of we'll be coming up with a risk defined strategy so that it will be suiting all the traders, whatever trades they are taking, for additional extra return. So how do we create a short strangle? It is completely simple. So we, based on the strike price or the risk appetite, you can go sell out of money options on both calls and puts. So that is how you create a strangle. So what we do for this strategy is we sell 200 points out of money call options and 200 points out of money put options. So for example, if Bank Nifty is trading somewhere around 35,000, we sell 35,200 calls and 34,800 puts at 3:15 p.m. on Wednesday, and exit at 9:20 a.m. and exit on 9:20 a.m. on Thursday. So this is the simple strategy what you can do to utilize extra funds whatever you have in your account, so that you will be able to achieve another 15 to 20% or 25% overall in a year. You can get additional return on your unutilized capital. So that's the reason we do this, because it's only one day a week you will be taking this trade. You don't have to risk more than that, more for this. You don't have to trade every day. There is only one day per week you will be taking this trade. So what we do is we enter exactly at 3:15 and exit exactly at 9:20 a.m. So I'll be just showing you the simple strategy and what will be the backtested result, so that you'll be able to analyze what you have to do. Please also note that capital requirement for this strategy is somewhere around 1 to 1.25 lakhs per set. Why is it? I'll just show it to you later. So based on the backtesting for 10 lots, not one lot, for 10 lots, what we see is somewhere around 13.16 lakhs of profits from past 4.5 years. That is, if I tell I have done 10 lots, that is 1 lakh into 10 is somewhere around 10 lakhs. So if on the capital of 10 lakhs, I have realized somewhere around 13.16 lakhs if I had done consistently from past 4 years. So yearly it will be somewhere around 20 to 25%, not more than that, for one day of trade. And probability of success, since we have high probability of success, probability is somewhere around 83%, and loss making days is somewhere around 17 days. Out of 206 expiries from past 4 years, it will be somewhere around 83% of win percentage and 17% of losing days. So this is the simple thing what we have learned, but what we have to see is on the risk part, because reward everyone will get, but once they follow the risk management properly, they'll be able to achieve it even better. Because what happens is sometimes market gaps down 5%, because unknown risk, there will be unknown risk of overnight, right? So you have to be careful on that, because one such day can erode all your profits whatever you have made, and it can get in a lot of mental impact also. So your trading decisions will hamper because of one trade. So you have to consider the fact that there will be drawdowns, but drawdown should be within your limit. So we have to have a drawdown. We have to make sure our drawdown doesn't exceed more than 15 to 20%, because once we do that, trust me, you won't be able to trade properly. I myself have felt it. So we know how when a drawdown hits, what will happen, what will be the trading psychology, what will happen. So what we suggest is that go small, go start with small, have a flexible drawdowns if you are able to take it. If you are able to take it, then have a plan to exit, have a plan to make sure that you don't fall for it. So the whole concept of this market is to staying in the game for as long as possible, because you don't know, someday it will be an amazing day for you, you'll be making some good returns, someday it won't, but you need to know what you when you have to cut out your trades. So that's the whole idea about this. So average profit on win days is somewhere around 10,000, and average loss on losing days is somewhere around 12,000 rupees. So simple, the entry will be at 3:15 p.m. on the day of before the day of expiry, that is on Wednesday. On the day of expiry, 9:20, after market opens 9:20 a.m., you will be exiting the positions. Okay, so in this, drawdown is somewhere around 1.16 lakhs, which translates to around 11% of your total capital, because we need 1 lakh for trading this strategy, and you will be needing somewhere around you would have drawn, if you have done this from past 4.5 years, you would have a drawdown now for around 11.6%. So that is some feasible one, but we have to see if there is a way that we can reduce our drawdowns and increase our profitability. If there is or decrease in profitability also, it doesn't matter, as long as your drawdowns is reduced. If you reduce your drawdown, then it's better, because you'll have a smooth curve. That is fine. Okay, so this is the monthly breakup from past 4 years. So you have seen there are 4 to 5 months which there are losses in the system. So there won't be any system wherein you will not have loss. There will be systems wherein you will have losses also, because profits and losses are parts and parcel of the game. So when it hits you, you shouldn't be taking it in a negative way. Please consider all your losses as a fee given to the market, because market is trying to teach you something. Please be positive and think that you can do better. Market has given you a chance to do better, but always make sure that you don't risk more than 1 or 2% of your total capital in a particular trade, single trade basically. So always have that, and once you do that, you will be in the game for a long time. So once you are in long time, you will be able to get it in a consistent way. So that's the whole idea of any strategy or any trading person, whatever they teach you. So that's the whole theory or the whole idea behind that. And this is the equity curve what we have seen. So what we have seen from past 4 years, it is a consistent return. So there will be a drawdown. So a drawdown is nothing but from the peak how much you have lost, and from the bottom how much what was the time to recover, or what was the time to come back to the same level. So that is the drawdown. And this was happened in this is in the somewhere in the month of 2000 in the year of 2018, somewhere around September. So that is the whole thing. And I was telling the capital requirement for one lot is somewhere around one set is somewhere around 1 lakh. Why? Because there is a particular reason. So the reason is this: when I hedge a position, I'll be getting a margin benefit of around 2.39 lakh. So my only margin required for selling one lot of Strangle with a hedge position is somewhere around 49,000. So I'm keeping double of my margin requirement to set off some uncertain event. So once we do that, we'll be getting somewhere around 49,000 rupees. So the only problem what we saw was there was slight higher drawdown. So if we are able to reduce the drawdowns, then there is nothing better than that. So drawdown, we should make sure that we have to reduce it. So because we'll be comfortable holding on to a position. So why is that? Why is this drawdown happening to us? So when the market due to uncertain event or unknown event, let us say there will be some war waging by North Korea on some evening. So markets, our markets are closed, and by next morning, markets will open somewhere around 3 to 4% gap down. It's an hypothetical scenario, but it can happen. So the puts leg will start to gain uh, amazingly high in the amazingly higher faster rate, and other leg will not lose because there will be spike in IV. So we have to make sure that we are not losing much. So that's the reason we go ahead 500 or 600 points away and buy an option. So for an option, when you are shorting an option, upside for an option is open. There is no limit, but downside is limited. That means an option can go from 0 to 200, but from 200 it can come only till 0. It can't go negative like crude oil, how it went last year. So that's the ideal scenario, and downside is limited. Second one, when things appear like this, our max drawdown is high. So that's the reason we need to make sure that we are safe from all these uncertain events, because we lose if we give out from our profits, that's fine, but we shouldn't lose our capital. That's the whole idea. So how do we solve it? It is pretty simple. We'll be placing a stop loss. I'll be telling you how, because for overnight you can't, right? So I'll be just giving you one more slight hint how you can keep a stop loss. And second thing was to hedge these legs. So hedge these sell legs and convert these short strangle in Bank Nifty into an iron condor. So once you do that, your risk is limited to a certain extent, and you can sleep peacefully on the day of that expiry also, because you know that something happens also, your position is not that bad because you wouldn't have taken so much of positions, because you need somewhere around 1 to 1.25 lakh, and your position sizing will be based on that. So what is the modification what we are doing? We are buying 600 or 500 points out of money option on the day of on the day before expiry. That is when I'm creating a short strangle. I'm also buying 500 points away from the sell X. I'll be buying that, and I'll be keeping a stop loss of 75%, which is as shown below. So let us say Bank Nifty, I have sold 34,800 put option at 200 and 35,200 call option at 210. So the stop loss for these legs on next day opening will be somewhere around 75%. So let us assume market opens 2% gap down or 1% gap down, and this 200 rupees option is trading more than 350, because 75% of 200 is 150 rupees. So if the option is trading more than 350 rupees, then you immediately square off the position. By 916. So wait for 1 minute for market to settle. So once the market opens, if the price is trading more than 350, that is 75% of the stop loss, whatever you are kept or whatever you have collected the premium, if it is more than 75%, you immediately exit. I'll repeat it. If the option prices opens next day, that is on the expiry day, more than 75% of the premium, whatever you have collected, let us say you have collected 200 rupees for 34,800 put options. If it opens somewhere around 352 rupees, 355 rupees, you immediately square off complete legs, all the 4 legs. That is sell leg of put option, sell leg of call option, buy leg of put option, buy leg of call option. So you square off all this and you close your positions. If it stays within 75% of total of premium collected on each leg, then only you hold on the position till 920. So this is one simple modifications what we have done, because we want to make sure our overnight risk is capped and our max drawdown is reduced. So by doing this, what will happen if the returns is reduced by slightly, that's fine, but we are also reducing the risk in this. So let us see the example, what the backtesting we have backtested. Once we backtest, we'll get to know what has happened. So overall profit reduces by almost around 3 lakh for 4 years. That is somewhere it's fine, because you're also minimizing your overnight risk, and for that you are paying little bit price because you're hedging a position, you're not having a naked position. And max loss also reduces, so max loss reduces to 74,000, and average profit also is good. And max drawdown, it significantly reduced by 20%, 22% or 25%. That is, in previous case it was somewhere around 1,20,000 or some 30,000, and in this case once we modify, the result is somewhere around 96,000. So 96,000 will leave us with somewhere around reduction in max drawdown by 25%. So that is good because we have our losses restricted, and if anyone is willing to take higher risk, they can go ahead with not keeping the stop loss and not hedging the position. But what we prefer is to keep the stop loss and as well as a hedge position, so that in case of uncertainty or in case of markets falling or going higher, we won't be losing so much, because we need to make sure that our risk is mitigated, because we can't completely rule out the risk involved in these trades. That's the reason we need to make sure that risk is controlled. Risk should be in our hands. We need to know what we are doing. So that's the reason we also hedge. We also keep a stop loss. So I hope so the stop loss placing part was easy and understandable. So that's the whole idea behind that. And because of this strategy, our max loss is reduced, and we'll be seeing the monthly breakup also. So this has given us a return of somewhere around 8.5 lakh on capital of 10 lakh in the course of 4 years. So it will be somewhere around 80% for 4 years, which will be somewhere around 20% a year. So the idea is to increase your returns. So once in a week you will be trading, and you can put your funds in other strategies also. So in the strategies, once in a week, if you do it, you might achieve somewhere around 20 to 25% on a year basis. So you can't expect more than that. This is a simple strategy what most of us do for extra gains. So this is how you can do, because of high theta decay on the day before expiry. So this also you can try. You can backtest it yourself. You can see how it goes, and you can also come up with different stop loss or different exit times what you want. You can comment, you can see all this, and you can comment down in the comment section. This is the monthly breakup. So you can see there won't be any significant drawdowns. Only in the October 2018 there might be some scenario wherein there was huge drawdown of somewhere around 85,000. I am not sure which day was that, or what was the scenario during that case. And only that day drawdown was high, but rest of that everything would have recovered. And in 2018 also you wouldn't be in loss. Entire year wouldn't be in loss. You would be gaining somewhere around 3.6 to 4% that year. But yeah, this one month there might be some other issue, but no problem. Over a longer period of 3 to 4 years, you'll be able to achieve decent returns of 20 to 25% from this single day trade alone. So this is the whole idea behind this. You can see the equity curve also. In September October 2018 there is some drawdown, so that's fine, because longer run, if you do it consistently, you'll be able to achieve decent returns. So what are the few advantages of modifications? That is, max drawdown is reduced by 20 to 25%, and max loss per day is also reduced from 12,000 rupees to 7,000 rupees. So 12,000 on 10 lakh will be somewhere around 1.2%. We have reduced it further to somewhere around 0.74%. So on 10 lakh, we are risking somewhere around 7,450 as a risk. So that will be the max loss per day. So this is an indicative loss, but it can't be, we can't rely on this telling that this is the same exact loss which will happen in future also. This is the idea which we'll be getting from any backtesting what we do, because the scenarios what would be there back then, the wicks, the premiums, bank nifty levels, all those won't be there in the future also. But we can see, we can analyze that, oh, this is the, if this was a scenario, this like this it had happened, and we can extrapolate things for next year, upcoming years also. So that's the whole idea of backtesting and relying on the system. Coming to the end point, why does the system always works? Because as long as concept of theta or premiums is there, you will be option selling gives you money, but you need to know what is the risk involved in it and when to exit out your loss making trades. So that's the whole idea. And market movement data of probability, that is market stays in the range of almost around 67% of times. So that is the scenario. And there are three ways how market can move on the intraday basis as well as the positional basis. Overnight it can go up, go down, or it can be open flat. So these are the three scenarios what can happen overnight also. On the intraday basis, there are range bound trades, there are trending days like in Nirmala Sitharaman candle, which is known on the budget day, as well as in 2019 or 20 in corporate tax cut. So these days markets trends, so markets moves in one big way, and that is called as trending day. And on the V-shaped recovery, there are days wherein markets goes 500 points, falls down 400 points, then again moves up 300 points, again falls 400 points. So this is a V-shaped recovery day. So these are the scenarios wherein intraday, whatever system we build, will all our stop losses will get triggered because there is a V-shaped recovery. So that is the case. And out of 2 out of 3 scenarios, it will always favor us because that is the strategy, or that is the probability what we have of being successful. So on that thing we rely, and that's the reason this system might work in future also. We can't give 100% guarantee that it will work. We might be, from the data what we have analyzed, we can say that 67% of the times we might be successful. So that's the whole idea of a system being profitable, and how whole idea of system being successful for a longer run. And second most important part is that there won't be any discretionary trades which you will be taking. That is, your personal bias won't be there in the market. You let the system take it forward for you, and you let the system give out results for you. I personally have seen system trades going from negative 3 lakhs or 2 lakhs to positive 4 lakhs, 5 lakhs. I have personally seen it. And for the position size of 1 crore account, so I have personally seen it. So I can I can tell you that the system sometimes makes wonders. Sometimes there will be drawdowns, that's fine, but it can make wonders also. So that's the whole concept of a system-based trading, and I hope so you have learned most of it from this trade. And if any inputs to be given, please drop it on the comment section so that we'll be able to come out with. I hope so the strategy what we learned today was informative and simple. This is a simple strategy which we deploy on Wednesdays and we close it on Thursday. If you have found this video interesting, please do share it with your friends and make them realize how we can do it in a systematic way. Share it with them, share it as much as possible, because that will encourage us to do even much better content. And if we have to improve our content, or if you have any inputs regarding what videos we have to come up, please drop it down in the comment section so that we'll be able to come up with that. So we'll be getting inputs and we'll be coming up with all those content. So for more such content, please like, share and subscribe Optionables. Thank you.